Let's keep the conversation going. Joining us here in studio, David Doyle. He's head of economics at Macquarie. David, obviously, so many people are concerned about where the economy goes from here, especially if interest rates stay elevated. So as you look to 2024, what's your view on what both of those former Bank of Canada governors are saying right now?
Yeah, so I'd largely agree with what David Dodge suggested, that the Bank of Canada, will be in a position to cut rates around the middle of the year. At Macquarie, we have them starting to cut rates in the second quarter. I think when they start to do it, it will be relatively tepid or gradual at first. But as you get to the back half of the year, I think they'll be increasingly confident that the appropriate course of action is to cut rates quite sharply. And that's largely in response both to a rise in unemployment that we're anticipating to persist, but also, I think, further progress on core inflation back towards the 2% target.
The unemployment rate, I believe, stands at 5.8% right now. What are your own forecasts on what will be happening in the jobs market or in the unemployment market?
So, yeah, that's right. The unemployment rate's at 5.8%, and I think up almost a percentage point from its trough, which is quite a significant increase in our view. We have it going over 7% by the end of 2024 and rising even further towards 7.5% in early 2025. And that's just a consequence of the weak economic environment that we're anticipating over the next 18 months or so.
You've talked to us throughout this last, call it 2 years now, really about the ramifications for higher interest rates in the housing market, just given the debt loads in this country. If the unemployment rate is rising and Canadians on average are deeply indebted, how does that play out? I guess that becomes one of the other considerations for central bank policy? I
think so. I mean, that's part of the reason why I would agree with what former Governor Pelot suggested, which is that we haven't felt a lot of the impacts of the rate hike so far. And in Canada, as you know, John, most people are on 5-year fixed rate mortgages, and that renewal headwind is set to grow in 2024 and 2025. So that's partly why we anticipate a weak economic environment. I think the housing market will be soft, given that rate reset headwind, but also due to the rise in unemployment that we're anticipating to occur will add to those headwinds for housing.
Now, for those who are saying, hold on a second, it's been so hard to get inflation back to target levels, and even there was some fresh dialogue around that in the United States today with their latest CPI print. Sounds like you do anticipate we'll see some more encouraging signs on inflation. How do you view the price story right now?
So I think both in the U.S. and Canada, I think the seeds have been sown for, further disinflation ahead. We've had some progress. I think there's further progress in the pipeline. I think it'll take, some time, though, to get back to that 2% target that both the Bank of Canada and the U.S. Fed are looking to get to. The reason is that you just have some factors or some areas within services that remain firm. And I think that while there's going to be progress, it's going to be more, 2 steps forward, 1 step back type of developments. And in today's report, in the U.S., you could see a bit of that. You had considerable relief on the good side of the economy, but services inflation remained relatively firm.
And so we could be in a position where inflation is technically not at this target level that central banks like ours look for, but interest rates could start to come down because of these other considerations that you talked about?
Yes, that's right. So I think how central bankers will think about it is in terms of the real policy rate, which is the policy rate less headline inflation or core inflation. And even if, monthly inflation numbers stay around where they are, that real policy rate will move higher. And so that's a reason to suspect that they will have the ability to start to cut interest rates around the middle of the year. But I think the bigger factor, at least in our forecast, is that we anticipate unemployment rates to rise from current levels. And when unemployment rate rises, the central bankers will be looking further out and thinking, okay, well, now there's more disinflation, more deflationary pressures in the pipeline because we've freed up some capacity in the economy.
And just to reiterate for our audience, we're at 5.8% right now, and you said you wouldn't be surprised to see that unemployment rate heading towards 7%. Meanwhile, compare the Canadian situation to the U.S. situation. We do have another decision on interest rates from the U.S. Federal Reserve this week. Most people would expect that there's not going to be any movement in either direction on rates. But I think that the messaging from the Fed, like some people were wondering whether they would be ready to just start a dialogue around the possibility of cutting rates, whatever that might mean. And I don't know if that changes after today's inflation report in the U.S.
Yeah, we don't think that's the case just yet. We think that's jumping the gun a little bit. We think that conversation might start in around March or April. I just think it's a little premature, given some of the inflation data and actually given the U.S. jobs report last week, to think that they'll move that aggressively. I think the Fed's shift will be similar to what we saw from the Bank of Canada last week. And the way we describe that is there's still a hawkish bias, but it's clear that hawkish bias is diminishing, right? So it's becoming less stringent than it was a month or two ago.
One thing I heard come up in our programming this week was the idea that if we're in a situation where hypothetically the Bank of Canada begins cutting rates earlier, at a faster rate, let's say, than the U.S. Federal Reserve, what does that mean for our Canadian dollar? And does that ultimately mean we start to import some inflation through just sort of the currency realities? Does the Bank of Canada have to be mindful of that as well?
Yeah, I think so, right? So it could well be the case that the Bank of Canada eases more aggressively than the Fed, particularly in 2024, when the economic environment might be a lot weaker in Canada. I think we're a long ways from that being a consideration at this juncture. I mean, the chart that your folks just showed there on the Canadian dollar showed it was really in a range, and it had been range bound for a year. I think if you saw a sharp decline in the Canadian dollar, something like 10% or so over the course of a couple of months, that might be something that the Bank of Canada would have to respond to, and that could impact their future subsequent policy actions.
Okay.